Okay, for this video, I want to go over the IRS Form 8936 for a qualified plug-in electric drive credit, and this is going to be applicable to the 2022 tax year. So I do have the sample 8936 in front of us, which we'll go through in full, and it is part of a full return Form 1040 for these taxpayers. So we have John Q, Jane Q taxpayer. They're married, filing joint return, and they did purchase two vehicles that are going to qualify for this credit. So we'll show how they claim the credit on the 8936 and then how it actually impacts the bottom line on their tax return. Now, in addition to this, I do have some other materials here that we're going to go through. So I have one slide here with some background on the form itself, the credit, what applies to 2022 and what is changing starting in 2023 and going forward. And then we do have some relevant websites that we'll go through as well. So I've got three websites, government websites that help provide some additional information on what vehicles are eligible for the credit, how you qualify, and what are the relevant amounts. So to get started, I want to go through this one slide first and then cover some of these websites, and then we'll get back into the 8936, the form itself. So again, just to recap here, this form is filed to claim a tax credit for certain types of qualified electric vehicles. So for 2022, the terminology used is qualified plug-in electric vehicle. There are credits available for other two-wheeled type vehicles, but in this case, we're just going to be covering passenger automobiles effectively. Now, the Inflation Reduction Act, which was passed in 2022, changed a lot of the standards for these credits. And so for 2023 going forward, the type of vehicle that now qualifies for this is referred to as the new clean vehicle tax credit, right? And so there's different standards than what we have today for 2022. So for this video, I'm covering 2022. So if you're filing a 2022 Form 1040, how do you complete this form? For 2023, it's going to be different. So I'll have to do an updated video with the new forms when that time comes. So what are the general specs in order to qualify for 2022? So the first one is it has to be a new vehicle, right? So you can't buy a used vehicle and be able to take this credit. Now, beginning January 1st, 2023, and again, this is because of the Inflation Reduction Act, there is now an option, there's another used electric vehicle tax credit that you might be able to qualify for. Now, it's not as generous as far as dollar amounts go, but now used vehicles are eligible. The second element here is the vehicle has to be propelled by an electric motor, and that motor draws electricity from a battery with a capacity of not less than 4 kilowatt hours, and it has to be capable of being charged by an external source of electricity, right? So notice how it is a plug-in vehicle tax credit. So those hybrid vehicles where you don't plug them in, but they have a battery that recharges from braking and things like that, that wouldn't qualify, right? This has to be a plug-in type of qualified vehicle. And then lastly, the gross vehicle weight has to be less than 14,000 pounds. So again, we're talking passenger automobiles here, right? This doesn't really apply to commercial grade type vehicles. Now, these three websites here, I'll put all of these links in the description below. So go check those out. But these are very, very helpful in helping you figure out, okay, what type of vehicle did I purchase, what year, and what kind of credit am I going to be able to take? So if we jump over this first website, fueleconomy.gov, very, very good for 2022. It also has another page for 2023 credits. But the way this page works, if you go to the website, you have to filter by scenario. So I'll get into this later, but when did you purchase the vehicle and place it into service? The reason why they have this August 17, 2022 cutoff is the Inflation Reduction Act. When it was made effective on that date, it changed the standard for what kind of tax credits you can claim during 2022. They added this additional element that requires that final assembly is done in North America. So that's why it's asking us one of these two options, right? Did we purchase it before August 17 and place it into service before the end of the year? Or did we purchase and place it into service on or after August 17 and then before the end of the year? So we'll go into this website in a little more detail later, but you can see that generally the way this works is, right, you pick the scenario, pick the make and the model of the car, whatever it is that you purchase or that you're looking at purchasing, and it'll tell you all the eligible options, right? So vehicle, make and model and year, what type is it? Is it an all-electric vehicle or is it a plug-in hybrid? And then the amount of credit that you are potentially eligible for depending on the type of vehicle purchase. Okay, so again, we'll come back to this one. This website is also very good. So this is the IRS website, and this IRS website provides information on a full list, right? So they have a full list of the manufacturers here, and then if you drill down, you can see the different makes and models that are eligible for the credit, and then more importantly, right, obviously, what is going to be the credit amount, right? So again, very helpful. I'll put a link to that website in the description below as well. And then last one here, this is the afdc.energy.gov website. This is helpful because if you are purchasing a vehicle on or after August 17th, and you're trying to verify whether final assembly was in America, you can use this website to search the VIN of the vehicle to determine whether that's the case. So we can see here on this tab, it says that vehicles purchased before August 17, 2022, final assembly in North America was not a requirement for credit eligibility, right? And that's again because the Inflation Reduction Act changed it, but they couldn't make it retroactive the full year, right? So it's starting on August 17th is that became an issue. All right, so if we jump back over to the slide here, let's finish this up, and then we'll get into the form itself. So what is the amount of the credit that you're going to get? Well, the credit is calculated as $2,900 and change for a vehicle with a battery capacity of at least 5 kilowatt hours plus $417 for each kilowatt of capacity over 5, right? So effectively, the way the math is going to work out for these vehicles is the all-electric plug-in vehicles are going to get the full credit, and then if you have some of those plug-in hybrids, you might have some reduced amounts. And so when we look at the website, we'll have a look at some examples so we can kind of illustrate what we mean there. Now, again, recapping this August 17 date issue. So for 2022, if a vehicle was purchased and placed into service on or after the 17th, it will only get this credit if final assembly occurred in North America. Again, another a standard that was added as part of the IRA. So vehicle owners can go to these websites, as I just showed you, check the vehicle's VIN, see if you qualify. All right, so here's the fact pattern that we're going to look at, and for our two taxpayers here. So remember, John and Jane are married and filing a joint return. So during 2022, John purchased a Kia Niro EV on June 15, 2022, and he took it home the same day. Jane purchased a 2022 Hyundai Kona electric car in May 2022 and also took the vehicle home the same day. Now, they're using the vehicles both for personal use, so there's no business use component, and that's important because when we look at the form, there are different calculations for whether the vehicle is being used for personal reasons or it is being used in a trade or business. Now, each vehicle here is going to qualify for the credit, and so we'll look at the website so we can confirm that. But also what's important here, and this is unique to their scenario, is that the full credit that they're going to get, they're actually not going to be able to derive the whole benefit because of an income tax liability cap. And I'll show you what I mean by that and how that works on the return. All right, so first thing, let's go have a look at the website, and we can see whether or not John and Jane's vehicles qualify. So remember, they bought the vehicles before August 17, 2022, and they were placed into service on the same day. Placed into service simply means, for personal reasons, when did you take custody of the vehicle and start using it, right? So think about, well, if you prepay for something, but it's still sitting at the dealer, you haven't taken it yet, it wouldn't be placed into service until you start using it. So they bought it before August 17, 2022. They are using, it was a Kia. And remember, the vehicle that John purchased was a 2022 Niro EV. So according to this website, he's going to get the full $7,500 credit. And if we look at Jane's vehicle, right, remember she purchased a Hyundai. Let's have a look. What was it? It was a Hyundai Kona Electric. Okay, so Kona Electric 2022. So it's down here in this range, right? 2022 Kona Electric vehicle, full all-electric vehicle, and $7,500 eligible credit. All right, so if we have a look at the form itself, so John and Jane, they purchased the two vehicles during the year. So they're going to enter the information in Vehicle 1 and Vehicle 2. So Vehicle 1 here, the 2022 Kia Niro EV, you have to enter the VIN number, very, very important, and then enter the date that it was placed into service. So very often with a personal vehicle, you buy it and place it into service the same day, right? You just take it home from the dealership, but placing a service is right the day that you take custody of the vehicle and start using it. Okay, so on line 4A, this is where you enter the tentative credit amount or the initial credit amount per the website that you looked up, right? So remember, $7,500 was the initial credit available for both of these vehicles, so we put that down on 4A. Now the phase-out percentage, what is this? The manufacturer, as soon as it sells and distributes enough vehicles, it's subject to a phase-out, meaning that because they've already sold, in effect, let's say too many vehicles, the amount of credit that's eligible for the new purchasers going forward is subject to a reduced amount. And so if you look on the website, it would also tell you whether or not there was any kind of phase-out percentage. In our case here, we can see that there's no phase-out being applied to any of these vehicles yet. Now, in the future, that's certainly going to be the case, right? As soon as they start to sell more of these vehicles, they'll be subject to those limitations, and then there's going to be phase-out amounts. If you look for some vehicles, like if we look at Tesla, for example, Tesla, because they've been leading the charge in this space, they've already sold so many vehicles that the amount of credit is not only phased out, but it's completely eliminated for basically most of their vehicles, right? So we can see that when you check the make and model, be mindful of not only the date range, but how much of the phase out applies, okay? All right, so back to the form here. So once you've completed part 1, again here, the phase out percentage, there's no phase out for these vehicles. Part 2 is the credit for business or investment use. Again, in this case, they're just using the vehicles for personal reasons, so there's no business or investment use percentage or amount that's going to apply. This is often used where perhaps you're an investor in a company and then you have an amount of pass-through tax credit that's coming through from the vehicle. And what's kind of convenient is the business return will include this, and then you just report the amount of credit on a 3,800 as a general business credit. But again, in our case here, these are personal use vehicles purchased, so we're doing the 8936 for credit for personal use of the vehicle. So on line 15, it is asking us, right, we skip part 2, so pull the amount from line 4C, right? So there's our $7,500 amount, amounts coming through from the credits. If the vehicle has 4 wheels, leave lines 16 and 17 blank, right? So these are 4-wheeled vehicles. They aren't 2-wheeled vehicles or 3. So we can leave those lines blank. We have the total down here on line 18. And then we add up the amounts on line 18 and report on line 19. So $15,000 is the initial amount of credit that the taxpayers can initially get. Now this part down here is where a lot of taxpayers get a rude awakening, right? So you might get a $15,000 credit, but the tax credit is non-refundable. So what that means is you can reduce your taxes, your tax liability, dollar for dollar down to 0, but if you have too much credit, it's not as if you actually get a refund check from the IRS. So let me show you what I mean by that. So keep that $15,000 credit in mind. If we jump up to their 1040 and we have a quick look at this. So page 1, obviously we're reporting their income, some investment income here. Their taxable income is $66,460. And then if we look at the amount of tax they owe based on that taxable income, it's $7,206. Now the credit, again, the credit for the EV credit is limited to your tax liability. So that's why when we go back to the 8936, we might have a $15,000 credit amount that could be used, But when we look at our tax liability coming from line 18 of the form, it's only $7,206, right? So the personal use part of the credit is limited. We can't take the full 15. We can only use $7,206. So on page 2, right, well, we complete, so if I go to Schedule 3, that's where the credit initially flows through to. So Schedule 3, additional credits and payments, we can see here in Part 1, non-refundable credits. We have line 6F, qualified plug-in motor vehicle credit, $7,206. So that is the amount that's flowing through to page 2 here. So it does reduce our taxes owed down to zero, right? The total amount of tax that we have owed for this year has been completely eliminated by the credit. But notice, we didn't get to use it all, right? We had $15,000 of vehicle tax credit, and we were only able to use $7,206. So there was some waste, right? And the credit does not get to carry forward, right? It's just completely lost for that year. So what are some planning opportunities here that taxpayers should consider? Well, if you think that the credit, you're going to get the full $7,500, perhaps that you shouldn't have bought both vehicles in the same year, right? If you can delay the purchase, buy one vehicle one year, buy the second vehicle the next year, so you stagger the credits, and then you're able to, better leverage them across multiple tax years. In this case, perhaps they didn't have that ability to do that, right? Maybe they really needed the cars, so they had to purchase them, or just poor planning, right? So again, be mindful of, even though that the dealer might tell you, oh, you get a full $7,500 tax credit, yeah, you get $7,500 per vehicle, but it is going to be capped based on your tax liability, right? So when you do your tax return, now if they had taxes owed of, let's say, $30,000, well, okay, in that case, they would be able to use the full 15 likely, right? But in this case, based on their total taxable income, their filing status, they only owed $7,200 in tax. And so they only actually needed one qualified credit, right? The $7,500 would have been enough to eliminate this rather than waste the other one as well. Okay, so I hope that was helpful. Again, these links I'll put in the description below. Go check those out. Very helpful, a lot of good information there. And I look forward to seeing you in the next video. Thank you.